Right, so welcome again, everyone. So we're looking at the exercise from the last class, and at this moment, we're looking at the question on the PE ratio. All right, we were discussing or trying to make sense of what PE ratio means. It means the price per share divided by the income per share or the earnings per share. When you look at the income statement, they already calculated the earnings per share for you. So you can simply divide the current price of 70 by 0.63 to know the current year's price to earnings ratio. Okay. But in that question, I put a slight twist to it. I said, base your answer on 3 years average EPS, 3 years average earnings per share. Because the earnings per share might change from year to year. When you're comparing two companies that you're interested in investing in, their performance, the performance of this company this year may be very stellar. And you're trying to take a decision, comparing with another company that their performance that year was not as good. If you do that, you stand the risk of losing sight of when the other company may have done well versus this other one. That's why I wanted us to look at the 3 years average earnings per share. In the case of Brinker Inc. or Chili's that we're looking at specifically, if you look at their earnings per share, it's a very classical example. 3 years ago, the earnings per share was $2.72. Again, always use the diluted because it's more reflective of the overall shares in the company. And then last year, they made almost $4, about $1.30 more, almost $4. And then in 2020, they made less than $1. So if you just base your calculation on these, they might seem to have an exorbitantly high PE ratio, and you're comparing with another company. So it can throw off your decision making. So I always recommend that you use the last 3 years average. So in this case, you sum up all these three earnings per share to get your average earnings per share for that company. That means there's a little bit of calculation you need to do, which will not be done for you on the income statement, okay? So you divide, in this case, the average of these three would be about, let's see, 4.5 plus 6 point, about 7 divided by 3 would be about 2.6 or something like that, right? So you divide 70 by 2.3. That should give you around 30 or 20, 28 or something like that. So when you're comparing this company, the earnings per share of 20 versus if you divide 70 by 0.63, which is giving you like 100, it's not as reflective of the company's true performance. Okay, that's really the point behind that question. EBITDA, I'm going to pick on somebody else now, or maybe somebody should volunteer. I want a volunteer to tell us, what does EBITDA mean? Mayokun, please unmute yourself, Mayokun, and tell us, what does EBITDA mean? Can you hear us? Not sure.
Yes, I can. I'm struggling with that one. I'm sorry.
Okay. All right. I'll look for somebody else to bail you out today, but next time I won't let them bail you out.
Thank you.
Uh, all right. Sister Shade, what does EBITDA mean? Sister Shade, you're muted. All right. I'm not sure if you can hear me right now. All right. All right, Sister Lola Mensah, go ahead. What does EBITDA mean?
I just want to try.
Please do. That's the idea. That's why I didn't want to record initially. Go ahead.
The earnings before interest,
Okay.
taxes, depreciation, and
amortization.
Amortization. Okay. Yes.
Thank you. Excellent. Good job. Good job.
So I won't be answering any question for today again. Thank you.
You already answered the one for like 3 weeks, right? Earnings before interest, taxes, depreciation, and amortization, EBITDA. And what it allows you to see is before they start taking out money that they owe, such as taxes or interest, as well as money that they set aside, such as depreciation. Before they start taking those out of your accounting, you want to see at that level, how is the company doing? And that's a very important number when you're doing comparison between multiple companies that you want to invest in. If they're in the same industry, why is this, and they're about the same size, why will this company have a lower EBITDA than this other company? There's got to be an explanation. Is there something that they're not doing properly, or are they spending more on one thing or the other? Because at that point, we haven't deducted interest. If you go back to this sheet, to the income statement, we haven't deducted interest, we haven't deducted taxes. It's still at the high level. Now, some income statement will not show it, like here, it doesn't show EBITDA, but you can calculate it yourself. They show EBIT, which is earnings before interest and taxes, but they didn't show EBITDA. You can calculate it yourself. EBITDA is important because the D and the A are not real expense. Remember, actually, we'll spend some more time when we get to cash flow statement talking about, correction for those kind of expense. But I believe I've explained depreciation to us in the past. Depreciation means, I will use the analogy of your own car. If you bought a car today for $20,000, and you want to replace that car after 5 years, let's say you bought it new for $20,000 and you want to replace it after 5 years. As a company, you are allowed to depreciate, that is, take money out of your income, or your revenue rather, I should say, every year, set it apart so that after 5 years you have 20,000. And what it does is, it is before taxes. So you are not taxed on that money. That's why it's an important number for companies. So they're not taxed for it. They can deduct it before they pay their taxes. Okay. So that 20,000 divided by 5 will be 4,000 each year. So each year you take out 4,000 from your revenue and put it in like an escrow account. You keep it there. And after 5 years, you go back to the dealer and buy a new vehicle. That's what depreciation really is. Okay. And amortization is similar to that, but it's like kind of preparing for some payments in the future, like money for insurance, money for what's it called, pension and things like that. It's setting apart money to take care of those kind of big expenses, so that your account doesn't get hit by hit at the same time, at once. You've already set it apart slowly or in bits over time. So since it's not cash, it's still money that you have in your account. Keep that in mind. We're going to be talking about that a little bit when we get to balance sheet shortly. It's still cash that you can use to run your business. However, from an accounting and taxation purpose, you have an advantage of not paying tax for it. So it's a very important number. Okay. If a company has, has been managing their numbers well, those at that point it's like a normalized number across the board, because some companies have different set of machinery that they bought. Two same companies would buy different equipment at different times. So it's hard to compare some numbers, right? But at that point, we haven't taken out those, like the interest you're paying on buying those items, or the taxes you pay, those things that can vary. We haven't taken it out yet. So they are comparable. They are numbers that can be compared to make a decision when it comes to, investment. Okay, let's run through the others so that we can now get into our class for today. I won't go through all of these. I would like the class to finish it up. So I asked for 4 quarters EPS. We already looked at the EPS. So please, when I send this assignment for this next class, I will send it as PowerPoint. It's just that it's big. That's why I normally PDF it to reduce the size. But I can send this as I'll post just this page so that you can fill your numbers in. That way we can see your numbers at the next class. Okay, the earnings per share and the analyst expected earnings. Let's look at those 2 numbers. I talked about earnings per share already. Okay, those are these numbers for the last 4 years. One good information that we get from Yahoo Finance is what is called the analyst estimate. There are this group of people in Wall Street. They are called analysts. They work for investment banks, and they are the ones that kind of look into the numbers of these companies very closely. And on an annual basis, actually even on a quarterly basis, publicly quoted company have to meet with the analyst and talk about their performance, talk about their income, talk about their projections for the next quarter, and stuff like that. So these individuals have an insight, and they're able to make an estimate of what the earnings of the company will be. In this example, they see the dot, the circle that is blue without the shading inside it. That was the estimate for Q1 2020. But Brinker Inc., Chili's, made much more money. They made 128, whereas they were expected to make 65 cents. When that happened, the company is said to have beat the earnings estimate by the analyst. And what it does is it tends to push up the stock price, especially if they do so consistently as this company has done. You see, this quarter they beat, that quarter they beat, that quarter they beat. Here, they beat slightly. The estimate and the actual are almost on top of each other. That's why you can't see the estimate. The estimate was 0.33. The actual is 0.35. Okay. So what the next one here is for the first quarter of 2021, which is the estimate is 77 cents per share, but they have not reported, so there's no actual on that yet. We'll see how they perform when they report. When a company consistently beats the earnings estimate by the analyst, it pushes up their stock's performance. So you want to look at how is a company performing versus that estimate, okay? When you're trying to take a decision on investing. Now, it's not, remember, like I always said, it's not, don't look at one thing, look at all the items. On that spreadsheet, the template that we talked about earlier, that's one of the things that I called out. Okay, the diluted earnings per share, I think we all can pull that now, which I had shown before. And the last line says retained earnings per share. So when the company makes net income, which is essentially the last line before you start going through all the other things on your income statement, when a company makes net income, I shouldn't say good, some well-established companies pay what they call dividend, okay? That is, they take a portion of this net income and they give it to their shareholders. So what is left is called retained earnings of that company, okay? And that's what the question is there. So to calculate the retained earnings, you subtract the dividend from the earnings per share, okay? So you know how much is paid out as dividend per share, all right? We all know where to see the earnings per share now, which is these numbers over here, okay? And in this particular example, I was saying, assuming they gave a dividend of $1 per share. Now, this current last year, they couldn't have given $1 because they made only 63 cents per share. But the previous year, they made $3.94 per share. So they would have, if it's a company that paid dividend, they would likely have paid dividend in that case. So the retained earning, if they had paid $1 for every share you own, the earnings that is left will be $2.96 per share. Okay, so the purpose of that exercise is to make us think through an income statement, the lines on an income statement. But like I always say, I'm not just showing us so that you look at numbers. I want you to think about what does it mean. And as you're going through this exercise, please keep thinking about that. If something is not clear, bring it to the next class and let's talk about it. Okay, what does this number mean? Why are we even looking at this number? What does it do for me to look at this kind of a number? Okay. All right. So that's a summary of our last class. Tonight, our focus is on balance sheet. But before I go into balance sheet, I want to see if anyone has any question about that assignment we just walked through. If not, I'm assuming that we all at least can read an income statement now, and we can make some judgment call by looking at an income statement. I'm hoping that is a fair statement. Yes, Sister Yetunde, go ahead with your question. You're muted right now.
Okay. You mentioned something in the last statement about dividends. I didn't get that.
Okay. So when a company makes money, thanks for asking. Let me go back to the income statement. When a company makes money, right, they make revenue. Making revenue is not making money. I mean, make net income, right? When they've taken out all their expenses. You all know how to get to that point now. But once they've done all of that, taking out their interest to money they hold, the taxes, the depreciation, and all of that, they'll come to the net income line, correct? Correct, Sister Yetunde? We're okay till that
Yes,
point?
Yes.
Okay. So if we look at this company, let's look at the year before, 2019, because they made better money that year. This 154.9 million that they make, generally speaking, most well-established companies, now not all, will take part of this 55 million and give it to their shareholders, but on a proportionate basis. That is, if I own 10 shares of the company and you own 100 shares of the company, they won't give us the same amount. They will give me their amount that is proportionate to 10, but they will give you amount that's proportionate to 100. So you get 10 times more. So what they will do is, this money, they will decide, okay, we're going to give, let's say, 50 million to our shareholders. If they do, they will then retain only 155 minus 50, which is 105 in the business. It's what is referred to as retained earnings. Okay. Now that 50 million that they are giving, they have to divide it by the total number of shares so that they know what they will give each person. Does that make sense?
Yes.
Okay, so let's assume they're giving 50 million out of this net income. They will divide that by the total number of shares, in this case, the diluted shares of 39.1 million. So 50 divided by 39.1 will give us about 1.3. So for every share that you own, you get $1.30. They'll just pay it into, they'll give it to you, give it into your account. So if I hold 1,000 shares of the company, they will pay me 1,000 times $1.30, which is 1,000, what? 1,300, something like that. Yeah, so they'll pay me 1,300 into my account. So that $1.30 is called the dividend per share, right? That you get. Okay. So what I was asking us to kind of think through with that exercise is what is left if in this case the earnings per share is $3.96 and they pay out $1.30, what would be the retained amount left in the company per share? It will be 396 minus 130, which is like 266.
266.
Yes. Does that make sense?
Yes. I have one quick follow-up to that.
Yes,
So
go ahead.
when you are looking at the company profile, will you know which one gives dividends and which one does not?
Yes, absolutely. And it's usually in the summary section here. And also, if you go to their the company's website, where I said you can download the financial statement,
Okay.
that financial statement is usually more detailed than what you find on Yahoo, right? So that will be even much more detailed. Okay. So if you look at the summary section here, they will generally state here if they have dividend. See where it says forward dividend and yield?
Okay.
These companies wrote NA. That means they don't have a dividend that they are paying out, at least in the short term.
Okay.
You know, if it's a company that has dividend, they will write there what their dividend yield is. And the dividend yield essentially is, you know, it's a percentage, essentially a percentage calculation of that dividend, you know, as it were. Okay. Yield, the term yield is really kind of, it's like the percentage value of that dividend, if you want to put it that way. Okay. Of anything. Generally, when they say yield in from financial point of view, it means percentage impact that you know dividend amounts to. Okay, so you can see it from here. Here, though, they said the ex-dividend date. What that means is those, if the company was going to pay a dividend, it will be paid to those that own shares of the company as of March 5, 2020. Okay. So if you bought the share of the company on March 6, you don't get a dividend. Okay. If they were going to pay a dividend. But if you had owned the share and you had it on record at the day they declared the dividend, which in this case is the ex-dividend date of March 5, then you will be paid that dividend. So that's another important thing to know, because not every company pays dividend. And when you're looking at investing in a company, you want to look at your overall yield, that is the overall percentage. If I invest $100 in this company and it grows by 10% to $110, the yield directly of that $100 investment is 10%. But if the company also paid dividend in that period, there's an additional, if they pay $2, so it's $12 on my $100 investment. So the yield, the overall yield of the capital growth and the dividend is actually 12%. You know, so the total yield is higher than from a company that didn't pay dividend. So you're looking at the overall, you want to look at how do you make money from investing in a company? It's either from capital appreciation, that is the stock value grows, or dividend. Those are the two primary ways you make money from investing, you know, in a company. So you want to know what is if a company is paying dividend and what the overall, you know, average dividend for the year is, for the company is rather year after year. And also another way you can look at it is if I go to the chart here, if I just put it on full screen, give it a second to load. If you look at it, they're probably just not paying right now because it's been a little bit of a challenging year for some of them. But typically, look at this D. Can you see where it says D on my screen?
Yes, sir.
So every quarter, this company has been paying dividend. Okay, up till March of last year, when things went bad, they were paying dividend. So I guess what they are trying to do right now is to really recover from COVID. That's why they have not been paying dividend in the last 4 quarters. Okay, but generally it's a dividend paying company. They pay a total of about, let's see, if you look at, let's just look at one complete year. 2018, they paid 38, almost 40 cents, 4 times. So about what $1.60 is what this company pays. So on an average a year, if you just go back and look at what their numbers kind of look like. Every year they'll give you, for every share you own, they'll give you about $1.50, which is significant. If you own 1,000 shares, that's 1,500. Apart from the stock value appreciating. Okay, so that's another way to find out. On the summary page, they don't have numbers because they haven't paid in recent times, but they have historically been paying dividend. Does that help you?
Thank you so much, sir.
You're welcome. All right. Any other question? Good question. Now let's dive into balance sheet a little bit. We started talking about balance sheet last class, but that was an intro, just to kind of get us thinking about balance sheet. There are 3 primary financial statements. There are a couple of other financial statements that can be used, but these are the primary 3 that every company is, will publish. It's the income statement, the balance sheet, and the cash flow statement. We have looked at income statement. We have just finished an exercise on that. Today we'll be looking at the balance sheet. Last week I started talking about the relationship between assets, liabilities, and equity. And that is where we'll take it up again tonight. So an asset is a property that a company uses or owns that they can use to make some kind of money. That's an asset. Okay. If you think about it from a personal point of view, your property that you live in is an asset, as it were. It's making money for you. Maybe you're not renting it out, but on an annual basis, under normal circumstances, it's increasing in value. So it's making money for you, maybe not directly, but indirectly. So it's an economic resource. Companies have machineries, they have vehicles. Those are assets. Anything that is used to make money for the company is an asset. Even the word asset in English means that, something that is of value to you. Okay. And then there is liabilities. Liabilities are your obligations. So it's not only debt, your obligations to pay people that supply you your raw materials, for example. It's a liability. If they give you their product and you're using it to manufacture your own, you should pay them. So it is a liability. It is an obligation. Now you use your liabilities to make money, but you have to pay for it to make money, for you to not be in default of that liability. Okay. And the third element, I was explaining this last week, that this is the basic mathematics that covers the balance sheet, really. It's 3 items: assets, liabilities, and equity, or what is called shareholders' equity. The real value that the owners of the business truly have. Another way to think about it is like the book value, the real value that's being built into the company, ownership that the people have. And I was using the illustration of buying a home last week. That when you buy the home has a value. That is the asset value. If you borrowed money to buy that home, that is a liability. Okay. If you assume, for example, that you just bought a home that's cost $300,000 as an example. At the time you bought it, let's assume that the asset value and the sale price is the same. So that home has an asset value of $300,000. But you didn't have $300,000, so you went to a bank and you didn't borrow all the money. You have $100,000, so you borrowed only $200,000. So at that point, your liability to the bank, your obligation to the bank is $200,000, and you have an equity because you have to pay the seller $300,000, and you had $100,000 saved. So you have an equity or ownership of $100,000 inside that $300,000. So both sides of the equation will always balance. The asset must be equal to liabilities and equity. So if I want to calculate what the equity I have at any point in time is, all I need to do is to subtract from the asset the liability. So let's say after 5 years, that home value grows from $300,000 to $325,000. The market value grows to that level. And in that same 5 years, if you have been a student of this class, how much will you do? Who can tell me what do you think you will have paid? That, you know, just as an exercise to think about one of the key things that we've done previously. I know that might be a little bit asking you to do too much. Let me just go into it. But let's assume that in that 5-year time frame, you've paid up. Since you were a student of this class, you owed 200,000, but you were not following the amortization, the loan amortization sheet, right? So you paid using the way I taught you, and you paid up 80,000 out of your 200,000 in 5 years. Excellent student. What is your equity at that point in time? I want somebody to tell me what would be your equity after that 5 years time. The asset is now worth 325,000, and you've paid up 80,000 of what you hold of 200,000. Anyone, please raise your hand and tell us what your equity will be. Do you want me to call somebody? Good. Pastor, please. Thank you.
I think, sir, I think the equity will be 80 plus 125.
80
that
plus.
should be 205, because if the house is bought for 200,000 and the house is now 325 and you have already paid 80,000 off, what you have paid off is part of the equity, and since the house value has increased by 125, then if you add 80,000 to the 125, then it's going to be, your equity will be 205.
Okay, so let's do it together. Maybe the numbers are mixed up a little bit. All right. Okay. So thanks, Pastor, for trying. The asset is now, if you put it on this equation, the asset on the asset side, this asset is now 325 because you bought it for 300, but it's now 325. The liability has gone down from 200 to 120. So to calculate equity, all we need to do is to subtract the liability from the equity, which will be 325 minus 120, because the liability has gone down from 200 to 120 by 80,000. So 325 minus 120. Who can do that mathematics for us?
205.
Thank you. All right. So Pastor did it. Pastor's number is correct, but I guess I was getting a little bit confused on how it was being calculated. So the equity you now have is 205 because you paid up 80, which goes to equity, as Pastor was saying, and also the asset has increased by 25, which also goes to equity, so a total of 205. You now have an equity of 205 in the property. That is the basic building block of the balance sheet. Now, there are a couple of other terms that you will see on the balance sheet that I want you to be cognizant of, and we'll look at an example tonight. The number one item is the total assets. Total assets is the summation of current assets and non-current assets. When you hear the word current in accounting, it means less than 1 year. That's what current means. Okay, that's a simple way to explain it. Less than 1 year. Okay, so total assets equals current asset plus non-current assets. Okay, and what are current assets? Current assets are assets that you have at hand right now that is really, cash or can be converted to cash within a period of 1 year or less. Those are current assets. And things that will fall under that are like your cash, that you have in the bank, or some cash equivalents. When I say cash equivalents, for those that have been a student of this class, what is an example of cash equivalent? even on a personal level. What's an example of cash equivalent? I want somebody that's been in the class to please answer that question. Yes, Biado. You're muted right now. Biado.
Oh, sorry, sir. Cash equivalent is something you can easily convert to cash.
As an example?
Like, for example, gold is a cash equivalent. Jewelries.
Example what?
Jewelries. Gold jewelries.
Not for the purpose of what we're looking at right now.
Like a car.
A car?
A car. A vehicle.
Maybe, because you can easily sell a car. That's an example, possibly.
CDs.
CD was what I'm looking for. Money that you have like in the money market, or money that's in certificate of deposit. Things that can easily be converted to cash. Yes, a big mommy.
Sorry, you already mentioned it. I was going to talk about like savings account, money markets.
Exactly. Thank you. And the reason that is important is that just as for people that I've told you, the worst thing you want to do is to keep cash. The worst thing any company can do is to keep cash, because that money is not making any money for you as an individual or as a company. So you want to put it in at the minimum. If you don't have any good investment to put that money into, at least put it into the money market. Let it match whatever the interest rate is being paid at that point in time. It will likely still be lower than the rate of inflation, but at least it's not, sitting down just as cash. So that's what is referred to as cash equivalent, things like, short-term investment like that. And then you have account receivables. When you see the word receivables in accounting, it means money that you are owed by some other person, primarily because you sold a product or a service to that company or to that people or whoever, but they haven't paid you. So it's a receivable. It has not, the payment has not been received. That is where the word receivable comes from. Okay, you sold it, but the money has not been given to you. So, but it's still a current asset because you expect them to give you back that money within the next year. And then things like inventory is also a current asset because you've already manufactured the product, you just haven't sold it. Now, that's an important thing to note when you're looking at an income statement. In as much as inventory is a current asset, when the inventory is too high, the company may not be able to convert all that inventory into cash in less than a year. Okay, so you want to check that how high is the inventory of this company? Is it growing inventory and not turning it into cash? And compare with other companies in the same industry, how high is their inventory? Inventory is good, but too much of it is bad. So a company that is keeping inventory more than they ought to is a sign that you want to be careful with them. In fact, we're going to look at ratios in a minute. There's a ratio that helps you to subtract, that requires that you subtract inventory when you're looking at liquidity. Because what if they can't, maybe that inventory might even become obsolete. And what they think they could sell it for, they can't sell it for it, So not all inventory is good inventory is the point, even though it's considered a current asset. All right, so current asset, cash or cash equivalent, equivalents and receivables and inventory. And then non-current assets, like I said, current means less than 1 year. Non-current assets are items that may not be easily convertible to cash, okay? At least in less than a year. If you want to sell that item, you may be able to sell it in less than a year, but there's the possibility that you may not be able to convert it to cash in less than 1 year. Those are referred to as non-current assets. Examples of non-current assets is what they call, if you look at the financial statement, they might just write PPE, or properties, plants, and equipment. That's what PPE means. There's goodwill. And then there are intangibles. Now, goodwill is an intangible. Goodwill essentially means the good name the company has. In accounting, companies are actually allowed to calculate the worth or the value of how they are perceived in the marketplace. Take, for instance, if I mention a company like, what's a good example? Let's say Costco. And almost everyone in the class knows Costco, right? And almost everyone in the class has probably bought something at a point in time or the other from Costco. But if I mention some other smaller company or some other company that's in the same business, you may look at me and say, what company is that? Now, if I want to go and buy something that is available in both organizations, it's more likely that I will have gone to Costco first than to go to the other company. And that can be quantified accounting-wise. It's called goodwill or good name. It's different from brand, because brand, that's another calculation that goes behind that one. But goodwill is more around, you know, the good name the company has that can be quantified. Okay. Now, brand is more like elements of the companies that is recognizable. If I put a logo, if I draw a logo here right now, you can recognize that logo. That is a brand of the company. Now, there are other intangibles like things like copyright that can also be quantified and priced. Okay, so those are all non-current assets. The other important item that we talk about is liability. And again, liability is broken down into current and non-current. Same thought process. Debt that you have to pay within the next year. And then debt that can be paid over time. It's not due within the next year. So current liabilities will be, again, your account payables. Payables is the opposite of receivable. Okay, receivable is what you will be paid because you have already provided a service or a product. On the other hand, payable is what you owe other people, the amount of money you owe others that have supplied a product or a service to you. Those are your payables. And there is current expense, accrued expenses. There are some expenses that you just haven't paid, but you've been keeping money aside, hopefully, to pay for it. Those are accrued expenses. And then debts that are due within the year. The non-current liabilities are your long-term debts, usually referred to as LTDs, your deferred liabilities and taxes. Okay. Other major liabilities like what you hold, the pension money that you hold, those that are working for you. Maybe they are not retired yet, so you haven't paid, but you still owe it and you need to pay it when they come due, or taxes that you haven't paid. Those are non-current liabilities. Okay, those first 5, 6 or so are very important definitions that I want us all to keep in mind as we kind of look at balance sheet shortly. There are 2 other definitions on the left frame that I'll just mention before going to working capital and stuff. Paid-in capital essentially is the money that is invested into the business. And I've already explained retained earnings earlier on. I explained that it's net income minus dividend. The income you made, and you take out the dividend you owe. That is what you keep. That's the income you keep. That's why it's called retained. So for a particular period, you can calculate that, and then you add the one that you kept from the last period or the last year to it. It will be the total that you have at the end of this new year. So if I retained 1.5 million in 2019, and this year I made 2.5 million and I paid $500,000, Then I have this year, what I have retained is 2.5 minus 0.5, which is 2. But I kept 1.5 in my account from last year. So total that I will have at the end of this year will be 2 plus 3 or plus 1.5, which is equals to 3.5. Okay, that's retained earnings and paid in capital. All right, this is a very important element of a balance sheet. What I have my mouse rolling around right now is called the working capital. As the name indicates, is the money that the business has at hand that they can really use to run their daily operation. The current assets minus the current liabilities. Okay, money that is cash or cash equivalent, that's if you need to pay a supplier, you have it available. It's not tied down in machinery somewhere. It's not tied down in inventory somewhere or some other things that cannot really be used. So current assets minus current liabilities is true capital, true money, if you want to say it that way, that you can use to run your operation within this current business year that you're looking at. That's what your working capital is. Okay. That's an important number because if a company's current liabilities exceeds its current assets, it will have a negative working capital. And they are going to go bankrupt, period, soon. Maybe not immediately, but soon. I was chatting, I think, in this class, in one of the classes, there's a company called Hertz, and I think most of us know Hertz. Hertz is a car rental company, one of the competition to companies like Avis, Enterprise. Hertz was one of the top car rental company a few years ago. But then they went and spent a lot of money to buy, more cars to use for rental. And a lot of their liabilities came due during the COVID problem of 2020 that became current liabilities. Unfortunately for them, their current assets could not cover that current liability. I was looking at them shortly before that, and I was kind of concerned about them. And eventually they did declare bankruptcy, and they had current assets, debt that were coming due last year, that their current liabilities rather, that were coming due last year, that the current asset, which is their cash and their receivables and inventory, could not cover. So when you're looking at investing in a company, you want to check that they don't have a negative working capital, especially on a consistent basis. It might happen once in a while, not on a consistent basis. I think I was chatting again with somebody this weekend and looking at the balance sheet of the company she was trying to invest in. She figured out that their working capital was consistently negative, which is why she chose not to invest in the company. Then the book value, I think all of us remember when I showed us the margin of safety. The book value is the difference between your total assets and your total liabilities, less intangibles. Okay? The book value is really trying to calculate the true value or the intrinsic value, as I was explaining when we were looking at margin of safety. So you have to take out intangibles. So essentially it's total asset minus total liabilities. While in the asset, we have taken out all the intangibles, like the copyrights and the goodwill. That's book value or the intrinsic value. And like I was explaining to you, a company's stock price should be at its book value because that is really the value of the company. Now, when the price of the stock is above the book value, it is overpriced, as it were. When it's below the book value, it is a value stock. And I've explained that to us for those that were in the class, not those that joined earlier, but when we go to the next class, or you can look at the video on intrinsic value, and you can get the same information. And the last one that I will talk about on balance sheet is called leverage. I explained leverage last week. leverage is total liabilities divided by the total assets. Leverage, the best way for me to explain leverage is how much money that is not yours that you are using to do business. Leverage is not a bad thing, but if you are over-levered, you stand the risk of bankruptcy, especially when those liabilities begin to turn into current assets. If you have not managed your current liabilities, if you have not managed your business well to the point that your current asset at that point covers your current liabilities, that company in the short term, they might be okay, but in the long run, they might have problems, okay? Because that means they are borrowing more than they have the capability to pay. It's just like someone that is earning $5,000 a month and went to buy a car that is going to cost him $1,000 a month, bought a house that will cost him $3,500 a month. So that is $4,500 already. That goes between the house and the car, and then went to the store and used credit card that he or she has to pay $700 a month. So already the outgoing is more than the incoming. Okay, even though I'm using kind of cash position to explain that, it's the same thought process. However, I explained last week that it's still a good thing to be levered. I hope you remember the illustration that I used, that I said if I have $100, I want to invest in a company, okay? And if I invest it in that company, I will make a profit of $20. But I used my own $100. My profit margin is 20%, which is 20 divided by, actually 20 divided by 120, because you're calculating divided by your total revenue. So it's less than 20%. 20 divided by 1/6, which is what, about 17% or something, is my profit margin. Whereas if rather than using my own money, I decided to leverage, that is, go and borrow money. Lever. The word lever is, I think when we were all young, we used to sit on this thing that if you sit on that side and I sit on this side, it moves up and down. That's where the word lever comes in. It's in engineering terms, it's something that if you place something on this side, will move something on the other side. Okay, so when you choose to use leverage for the same investment, I can go to 10 people. Let's say I don't have my own money and I still want to invest in the same investment, and I borrowed $10 in 100 places. Actually, I shouldn't use that. I will use $50 of my own money, and then I will borrow $50. So I'm leveraged 50% and 50% levered at that point in time. Okay, I have a total asset of 100 in my hand, but I borrowed 50 out of it. All right, so I still am able to invest the 100 and I make 20. So I still make 20 out of investment of 100. But my margin now, is 20 divided by, if you're calculating it on the base of what I hold or what I own, it's 20 divided by 50. Now, you need to pay interest on the 50. So if you subtract the interest, I'm just going to use a quick number. Let's say I pay $5 as interest. I still keep $15 of what was left. So 15 divided by 50 is higher than 20 divided by 120. Okay, 15 divided by 50 is what? 30 divided by 100, which is 30%. Whereas 20 divided by 120 is 17%. So from a percentage or effective use of money point of view, it's a good thing to be levered. But when a company is over-levered, they stand risk of bankruptcy in the long run. when their current liabilities begin to exceed their current asset, which is what happened with Hertz. Okay, I've taken a long time on this spreadsheet, on this page, because if you understand that, you get the basis of a balance sheet. One of the things that I've shared with us is this summary of ratios and definitions. The ones used in income statement, which we've already covered, is defined on the top. Balance sheet, I spoke about some of these on the last slide, but I'll quickly go through a few. There's what is called current ratio. Current ratio is similar in a sense to looking at working capital, but turned into a ratio. So current ratio is current asset divided by current liability. So if I want to invest in a company, you can tell me what I should expect from a current ratio. Should it be greater than 1 or less than 1? Anyone, please, I need someone to tell me. Current ratio is current assets divided by current liability. If I want to invest in a company, what should the current ratio be?
You want it to be greater than 1, sir.
Thank you, Pastor. The current ratio has to be greater than 1 because that tells me that my current asset is higher than my current liability. The numerator is higher than the denominator. So when you look at that spreadsheet that I gave you, one of the things that I want you to write out there, state there is the current ratio. Okay, and I have here that ideally you want to look for a company that has a current ratio of 1.5 or more. What that means is their liability is completely covered and they still have money left over in their pocket. Now, it doesn't mean unless you have 1.5, you don't want to invest. You want to look at more than that particular item. But one of the things that you're looking at is the current ratio. It has to be greater than 1, preferably greater than 1.5. In this example, Cheesecake Factory has a current ratio of 0.4. So if I was going to take an investment decision, I really shouldn't invest in Cheesecake Factory. At the point I gathered this number, okay? Price to book, ideally, if you're looking at a value stock, what would you expect of your price to book value for a value stock? Question to the class. I want somebody to answer that question. Anyone, please. What will you expect of your price to book ratio for a value stock?
Less than 1.
Less than 1.
The answer is actually in front of you. I just wanted you to say it. It says here, PB less than 1. That is, the price is less than the book value. Everybody in class, apart from those that are just joining us, can calculate the book value now and use that as an investment decision. And that's also one of the things that's listed here, the PB ratio, price per share to the book value per share. I mentioned this earlier on. Now, the problem with current ratio is that current assets includes inventory. Remember on the last slide, current assets includes inventory. You are expecting that those inventories, you can convert it to cash at their current value. What if something happens and that inventory becomes obsolete? So in order to correct for that in accounting and financial analysis, we subtract inventory from current ratio to calculate what is called the quick ratio. What the quick ratio does is it gives a little bit more credence to your current ratio, because if your inventory becomes invaluable, as long as your quick ratio is higher than 1, you still have your liabilities covered. So your current ratio might give you a current ratio of 1.5 and the quick ratio is 0.9. That means that company's inventory is too high, because if for whatever reason they cannot convert, then their liabilities may not be covered. Okay, so quick ratio is another important ratio, which is simply subtract the inventory from current assets and then divide by liabilities. Margin of safety, we've talked about this so much in this class that everyone should be able to calculate it. Essentially, the book price minus the price per share. And intangibles will also be seen when we look at the balance sheet in a minute. Leverage, I've talked about the assets, which is asset liabilities plus equity. The asset turnover, the sales divided by total assets. The reason I'm giving you this, it becomes a little bit more complicated when you start using all these ratios. But again, I'm not expecting that we'll become like a Wall Street type analyst. But it's good to have this kind of depending on how deep you want to go with these things, to have it in your pocket. It's called an assets turnover. It's a representation of how effectively a company is managing its assets. If you have two companies that have a total asset of $1 billion, and this company with the same asset made a total sales of 100 million, whereas using the same total asset, this other company made a total sales of 300 billion, which one will you invest in? I will invest in the one that made 300 million using okay, maybe I'm mixing it up. Let's say to make it easier, 1 million is what they both have as their total assets. This company made 300,000, the other company made 100,000, right? That means the sales to assets for one company is 30%, the other is 10%. Which one will you think is a better run company? The one with the higher assets turnover or the one with the lower assets turnover? Somebody? Yes, go ahead, Beado. You're muted.
The higher asset turnover.
Thank you. A higher asset turnover, because their base is the same. That means what it means in principle is that using the same set of people, the same comparable set of equipment, this company is making three times more sales. So what are they doing better than this other company? Maybe they are advertising better. Maybe their salesmen are out in the field much more efficiently. Whatever it is they are doing, make it a more investable company than the other company. Okay, so the asset turnover is a very useful ratio when it comes to investment decision. The debt to equity ratio, the total debt divided by the equity, it just helps you to understand, how much of the shareholders' ownership in the company, is kind of relatable with the debt. If the company has an equity of $100 million, as an example, and they have a total debt of $150 million, even if they sell all the shareholders' equity, it will not cover their debt. So the lower that amount is versus one, the better. Okay, so they're not over leveraging also versus the equity. Then I showed us working capital. Working capital and current ratio really tells us the same thing. It's just that the current ratio gives it to us in an easily relatable number versus one, instead of an absolute number with the working capital. Okay, so those are the useful ratios when it comes to balance sheet. Any question before we look at an example of balance sheet for tonight? So when you're doing your assignments for this next class, please, we're going to continue to look at Brinker Inc. or Chili's. I want you to fill out this spreadsheet along with the questions that I will ask. Give some information as much as you can. Now, you may not be able to fill out all of it, but whichever you can fill, go ahead and fill. For example, the 52-week price range for Brinker Inc. EAT. If you go to that summary page, it shows you the 52-week range. Think about this. This company was sold 52 weeks ago, $14.50. And in the period of between then and now, it's currently selling for $70. It has sold as high as $78. Imagine if I had if you or myself had invested $14.50 and you bought 1,000 shares for 14,500. You know, in that period, it currently be worth $70,000. But the range of the price in that period was between 14.5 and 78.3. And that's what that spreadsheet is asking you for here. What's been the range, the low and the high? Those are numbers that, you know, we need to be thinking about as we start looking towards investing. When we start doing technical analysis 2 weeks time, that's going to become more important to be thinking through those ranges and stuff. We have not done technical analysis yet this time, so most of us on the line may not know support and resistance yet, so we'll skip that. The recent highs, also on that page, it will show you the 52-week, well, in this case, the 52-week high. It doesn't show you directly the high, but we can see that when you look at the chart. Let's keep that for now until we get to technical analysis. The year of the high, the recent lows. We'll come back to all of them later, but anyone that you can feel, go ahead and feel.
Prof.
Yes.
Pastor
Dave. Okay, sorry. I thought you were talking to me.
Oh, because we can appreciate.
There are a couple of other things that you may not be able to feel yet, but whatever you can feel, I just want you to start feeling it, okay? Whatever calculation you can do, start doing it. Some of the calculation will be done for you by the spreadsheet directly. Start using this spreadsheet, especially for your personal investment analysis, okay? All right. Let's look at, so again, we'll go to financials. Last week, we looked at income statement, and again at the beginning of tonight. Today, we'll go to balance sheet. Which company am I looking at? I actually don't want to look at this because that's the class assignment. So I'm going to change this to Walmart. So rather than look at Brinker, I'll look at Walmart. So if you look at this, you can easily see the construction of what I showed us on that page. You have total assets, you have total liabilities, and you have total equity. So 252 is equals to 164 plus 87. Top line, asset equals liability plus equity. Okay, you'll see that over and over. So the first thing is this company growing? Because remember, the asset shows the resources that they are using to make money. So is the company growing? Over the last 4 years, they have grown by $50 billion. Yeah, so the company is growing on an average of about $12 billion a year. Is it an investable company? Based on that line item, yes, for now. I'm not saying I'm investing, but is it investable? Yes. It's not the same as if it had gone down from 200 billion to 100 billion. Then why is the asset going down? In some cases, they sold some assets, which you will need to read through when you see that happen to figure out why the asset is going down. Liabilities, they're growing liabilities, but the fact that they are growing liabilities is not necessarily a bad thing if they are turning it into sales. And then equity is growing, 80, 81, 87. Okay, so you and I as shareholders, the value we have in the company has grown by 7 billion over the last 4 years. Those are the kind of things you want to be thinking about. Okay, if the asset is growing but the equity is going down, why? That means that the liability is growing faster than they are able to turn that asset into, value. So you want to be cautious. If a company is growing in its asset base, but its owner's equity is dropping on an ongoing basis year after year, it's probably not where you want to put your money. Something is going on. They are borrowing more than they can, biting more than they can chew. Okay. All right. And then when you open up each one of those lines, it now has under total asset, current assets and non-current assets. Under current assets, you see again cash and cash equivalent, receivables, inventory, and some prepaid assets. In this case, a prepaid asset for a company like Walmart would be maybe those of us that go to Sam's Club and you buy their Sam's card. That is a prepaid money that you have to pay, those kind of things. Then the non-current assets, the plant, properties, and equipment. And then you have that broken out for you here. How much is land and improvement? How much is building? How much is machinery and other properties and construction that they have in progress or lease? That is your PPE. Then you have also under non-current assets, goodwill, as well as other intangibles like copyright. For a company like Walmart, most of their intangible is really goodwill. Look, they have almost $30 billion in goodwill. And you expect that that is the case. A company like Walmart is pretty big with fairly huge notoriety around the world. But they don't have copyright and they're just buying and selling. So they really truly have no copyright. So this section is mostly their goodwill. Okay, so you see all the things that I mentioned on that table kind of listed out there. Then under liabilities, you have current and non-current. Then you can go in and see the things that are payables, pensions, debts that are coming due in the next year, and some deferred liabilities, you know. And then non-current liabilities like their long-term debts, as debts that are not due in the next year, and then other liabilities, maybe pension and things like that that are not due in the current year, the current fiscal year. So those are the elements of the, balance sheet. And then as you come down, you'll see things like the working capital will be shown here. It's interesting that Walmart has negative working capital year after year. And then the total debts kind of repeated here. And then their shares, which should be the same as is stated on the income statement, is also shown here. Okay, so I've taken us through all of that, and to practice looking at the balance sheet, we will review it again at the next class, but we are going to have an assignment. So for the purpose of making it like a continuum, we will look at the same company, which is Brinker Inc., Chili's, Eats. And the question is that I'd like you to calculate the book value per share for them, their PB ratio, current ratio, quick ratio, goodwill, and look at the intangible assets. For some of them, for example, and I've already answered that for us here, current ratio. So what is the implication if greater than 1? So I'd like you to explain it again here. Quick ratio, what does quick ratio tell us that we don't get from current ratio? Again, please write it down for yourself so you can go back to it and remember. Goodwill, what's their goodwill? Just look at it on the balance sheet. Intangible, account receivables, payables, PP&E, long-term debt, working capital, and leverage. And there's a question here, what is the implication of leverage being greater than 1? And we already answered that question tonight. Give examples of PP&E. And what are examples of intangible assets? We have answered all of that in a sense or the other tonight. But just to practice and to remind ourselves, that will be our assignment for balance sheet for tonight. All right, so that will be the class for tonight. I'm going to stop there. We've covered a lot of material on balance sheet tonight. And I want to kind of pause instead of, we have just 12 minutes, instead of going further to talk about any other thing. and see if anyone has any question on this exercise 3, something you'd like me to clarify. But please, like I always say, spend some time to go through this exercise. They are very valuable because it forces you to think about what we're talking about. And really, also, as you're looking at it, think about some of the things that I've talked about tonight. What does this mean? Current ratio, for example. What is it really telling me? Because when you're doing your investment analysis, you put it in that table. If you don't know what the number tells you, you just put in numbers. Okay, so please think through it. And if something is not clear to you, feel free to call me. Okay, if you call me in the evenings, I'll take it, or over the weekend, or wait till the class. And when we're dealing with the exercise, we'll go over it once again. Okay, please do the assignment. It really helps to make